Good evening. This is Ken Long from Tortoise Capital, and I want to review a new indicator that we're using and that we've added to the daily and weekend report called the Risk Index and the Risk Z. And this is based on some research from the smart guys at Empiritrage, so hat tip to them. And these are the values of the indicator from January 4th, 2013, after the close of the market. So the first thing that we're going to do is look at the VIX index, a measure of implied volatility of S&P options on the Chicago Board of Trade, or Chicago Board of Exchange. So it's a measure of implied volatility for the market. It's considered to be a gauge of fear. So what we're going to do is we're going to look back at the daily values of 20 years, or approximately 5,000 trading days. And we're going to look at the daily measurement. A lot of math goes into figuring out what that number actually is, but that's not important. What is important is a relative reading and how it's interpreted. So we're looking at the VIX index. And in those 5,000 days, the average reading of the VIX is 20.69, the average. The highest it's ever read, or the most fear, was 80.86. The least it's ever been is 9.31. And the standard deviation of those 5,000 values is 8.49. So in the usual way where we describe normal as being between plus and minus 1 standard deviation around the average, that sets an upper boundary of normal at 29.18 and a lower boundary at 12.19. So any reading under 12.19 we would describe as abnormally quiet. Anything greater than 29.18 we would describe as abnormally volatile. Today's reading, as a point of reference, is 13.83. And so the direct Z of the VIX would be in just above 1 standard deviation below average. In other words, or now the Z of the VIX itself is this. The 8.86 reading was 7 standard deviations above, and the minimum score was a minus 1.34 below in terms of Z. So the fat tail to the right. Now, according to the research from Empiritrage, when the 30-period moving average is greater than the 10-period moving average, you have a risk-on condition. That when the shorter-term moving average is lower, then there's less fear, volatility is coming out of the market, and you want to be in own risk on assets. And conversely, when the 10-period moving average is greater than the 30, you want to own risk off assets. And in their longer-term systems, they've looked at some buy and hold that is modified by that sort of market classification. That adds about 2 to 3 percentage points, if memory serves, to the to general buy and hold strategies. So to make this a little more powerful, what I've done is I've taken the 30-period moving average and divided it by the 10-period moving average, so we get this MA30 divided by the MA10. And when those two are exactly equal, it'll give us a value of 1.0. And if the 30 period is greater than the 10, it would be a number greater than 1. And then that's the equivalent of, being owning the risk on assets. And if it's less than 1, then we would want to position into risk off assets, whether that's cash or going short or bonds or something like that. Let your risk be your guide. So now what I'm going to do is I'm going to compute the descriptive statistics for each of those 5,000 look-back periods for the index value that's created by dividing the 30 by the 10. And so we're going to call that the index, or the risk index. The greatest that number has ever been in the last 5,000 days is 1.27. The lowest it's ever been is 0.7. The average is 1.01 with a standard deviation of 0.08. And so that sets a boundary condition on the downside at 0.93. So anything less than 0.93 would be considered abnormally quiet. And then anything greater than would be anything less than 0.93 would be abnormally volatile, and anything greater than 1.09 would be abnormally quiet. So the normal condition is between 0.93 and 1.09. Well, when we take the z-scores of those, what we'd find is that 1.27 had a z-score value of 3.3. In other words, 3.3 standard deviations above the average. So whenever that number is, whenever the VIX risk index, or what we're calling the risk index, is less than 1, we want to own risk assets. So today's current values are 13.83 for the VIX. The moving average 30 is a 16.5. The moving average 10 is 17.13. So when you take 1650 divided by 17.13, you get 0.96. So that's less than 1. Therefore, it's shaded red, and we would want to be owning risk-off assets. That 0.96 has a standard deviation value of minus 0.53, which means that it is a normal reading but below 0. On the daily report, I summarized this table to show just the today's important values, basically the last two, and I'm hiding all these intermediate calculations to save space and in order to focus on the readings that matter. These are therefore summarized in the key indicators, and that's what you'll see. You'll see this table on the daily report on page 1. Now, I am tracking two different time series here, and you'll see those on the daily in a reduced scale. I'm basically showing the last 30 days of this on because of the scale is smaller, but this one actually shows 180. On the daily, you'll see this arrayed as just these last two humps are the 30 days. So today's reading on the z-score, that's the top one, which shows the normal conditions between 1 and minus 1 standard deviation. That would be normal. This would be above average in the white, below average in the yellow, well below average in the red, well above average in the green. So the boundary conditions are 1 and minus 1. Today's reading is minus 0.528, and you can see that inside the blue circle. At the start of the week, this was down below 1, and so if the z-score is ever greater than 1, it's exceptionally quiet. If it's less than minus 1, that should read minus 1. Let's make that change right now. It's exceptionally volatile. And in either one of those extreme cases, be ready for an abrupt shift in market condition. It was an extraordinary sell-off that raised a lot of fear around the fiscal cliff, which proved to be false fear, I guess. And then it got down to below 1, it was like minus 1.25. And then there was a sharp resumption this week of the bull, and so that shocked the market, and the fear has left the building and getting less fearful, and it's moved all the way back to minus 0.528. Now the slope score itself, the index, is still 0.963, so it's still less than 1, but you can see that it's healing, and as soon as it gets above 1, then we will be back in a risk-on condition. However, by looking at the extreme cases, we were actually prepared for the long side move to take advantage of that when it occurred on Monday of this week, and so that's and then the follow through on Wednesday. That turns out to be important moments in the market to recognize when it is below 0. I mean below minus 1 here, especially here and here. This last one corresponds to the last time that it tested the 200-day moving average in June, and this was the test in December, and this was that harsh sell-off from the last week. Right, so that's essentially the the risk index. Then is the number that's generated by dividing the 30-period moving average by the 10, and the indicator is if it's greater than 1, then own risk on assets. If it's less than 1, you want to own risk off assets, and that's what this blue line represents, is that time series. You can see it was below 1 but getting better. And then the risk Z is when we apply descriptive statistics to that, and the extreme conditions to look for dramatic shifts in market condition, those critical states, if you will, is when that number is greater than 1 or less than -1. And those represent key every one of these key turning points where the market had a sudden shift after it moved out of the normal range was a very important turning point in the market. So it behooves us to know when we're in that kind of critical state, because that's when the abrupt shifts really occur. So 2 different ways to use that information to help us. So thanks for your kind attention and good trading.